Good afternoon, traders and investors. Will back here with another one, coming to you with a Tuesday market recap. Hopefully you guys are doing very well today. And in today's action, guys, well, the market's taking a little bit of a tumble. The heat map looking something like this. Only big tech and semiconductors performing well today. The rest of everything really taking a bath to the downside. Now, today we had an absolute ton of news, everything from macroeconomic releases to some earnings as well. And maybe you might have a lot of questions and are scratching your head at the end of the day today, and it's fairly normal. Inflation came in roughly in line with expectations, but we're getting headlines like this: inflation accelerating in June as investors are eyeing tariff-related price increases, even though the numbers came in roughly in line. So is that it? Is that the end of the bull run? Are we going to start tumbling in the same fashion that we did in February, March, and April, with the tariffs being front and center for concern? We're going to take a look at that later on in the video, of course. We also had some earnings from the banks, and you can see financial sector right now down 1.71% on the day. But why? Most of all the earnings were actually good. JP Morgan topping estimates and having record profits. Wells Fargo also beating profit estimates, record profits there as well. So why is the entire financial sector down an absolute ton today? And in other news as well, why does NVIDIA keep going up? Well, it might have to do something with the new arrangement here between them and China for the exports of their H20 chips, and so much more, guys. Why are China names up about 8% today overall? A lot of them doing fantastically. Well, there's a few different indications there, but namely, it was China's second quarter GDP that came in above the estimates. So a lot of questions are on the table today, guys, and my goal is to be able to answer most of them for you. And in today's video, as a matter of fact, we're going to do a few things together. Number one, we're going to, of course, talk about the inflation print. Is it as bad as some of the headlines are portraying, or is that just being a little bit of a sensationalist headline for the day? Number two, we're going to take a look at some of the bank earnings, JP Morgan and Wells Fargo to be exact. We'll take a look at what's happening in terms of their net interest income, their profits from trading and investment banking, and also, are they putting more money aside for the consumer? Do they feel that their loans are possibly at risk right now, or is everything kind of doing fine behind the scenes? Thereafter, once we're done the bank earnings, we'll take a look at our major stock market rundown, take a look at the rotation, or rather lack of rotation today, by doing an index deep dive across all our major sectors. Thereafter, we will do the same thing, take a look at some of our big tech names on the list right here and derive which ones could possibly be some good trade opportunities and also some good long-term portfolio opportunities as we position into them leading into their own respective earnings over the next 2-3 weeks. And at the end of the video, guys, we'll of course go through the biggest gainers and losers of the day. Some names a little bit familiar in terms of the last couple days of performance. Other names are new on this list to the upside, namely Trade Desk getting included to the S&P 500, looking very good. And then take a look at some of the biggest losers of the day, and you'll notice a common theme. A lot of banks right here, and mostly interest rate sensitive plays, because since the inflation narrative today was a little bit higher than anticipated, right? Well, it of course has an impact on yields. Yields coming up in a significant fashion. The 20-year yield now back above 5%. Oh no, right? So that being said, the Fed might just not need to cut that quickly. So a July rate cut is probably out of the question. But now people are starting to question whether or not they're going to actually do it in September. So a lot of things to talk about in today's video, guys. Let us jump right into it right away, shall we? So the SPY down about 0.43, the Q's up 0.09, and you can tell by the equal weighted S&P right here, it was not a very good day for the broad-based market. Most of all your major sectors ending in the red, except of course for tech and semiconductors overall. Taking a look at your one-day relative performance here, everything except for tech, guys, big red, and some more red than others. Healthcare also with a couple negative headlines, not looking too good there. But the funny thing is that on a one-week relative, guys, even in spite of today's relatively big sell-off, depending on which sector you are exposed to, we are still somewhat balanced overall. Half of your sectors performing well, the other half not too good. Healthcare, consumer defensives, energy, financials, and basic materials. And now real estate. It used to be positive before today, but now that also tumbling to the downside. So overall, I wouldn't say there's any major red flags, but definitely today must have thrown a lot of people out there for a bit of a curve, right? So that being said, before we get into more technical analysis, let us take a look at the infamous inflation print and determine whether or not the headlines are a little bit sensationalist, right? So let's have a look right here, exactly what happened. So your year over year, right, came in at 2.7, which is the expectation. Now, people are concerned because it came in above the print for May, which was 2.4. And of course, when you come in hotter than expected in terms of the recent month, well, the accusations instantly become that it must be because of tariffs, right? Well, we're going to deep dive that and get to the bottom of this. Food excluded consumer price index, this is core, excluding the very volatile prints of food and energy. That was actually down in relation to the expectation, 0.2 versus 0.3. And here you go, the overall core year over year, that was month over month, year over year, 2.9 versus 3%. So when you exclude the two most volatile categories, inflation, as measured by core, actually did come down. Let's take a look at some of these sector breakdowns here for inflation. So here's our overall read. Here's what people are concerned about. This tiny little uptick from May all the way here through June, but we're still well under the reads that we got in February, or even some of the reads in the 3 percentage points last year. So the trend of inflation is still very clear in my opinion, and you can see that by several major sectors here coming down. Now, food at home has been coming a little bit higher here over the past roughly, let's call it 6 to 9 months. But I wouldn't blame that on tariffs. We've been on an upswing here since pretty much July and August and September of last year. It is just normalizing, right? We had these very same inflation prints on food all the way back in like 2015, 2012, 2011, but nobody talks about that, right? And here, of course, is the major impact of inflation. We are net down overall on that. A sticking component of inflation has been shelter. However, shelter has been smoothly coming down. And that's important, guys, because shelter costs are usually people's most important portion of their budgets, their monthly budgets, right? Representing anywhere between 50 to 70% of people's disposable income to spend every single month, yeah? In terms of apparel has been on an uptick here from May to June, but you can notice it's still negative. It's still in a deflationary environment overall. And when we do services, we know that services have been a bit more stickier than goods. We can see here that services coming in exactly the same here for June and May. So it's definitely not coming from services overall. So where's it coming from, guys? Well, let's have a look right here as to what the article is saying, despite having a, somewhat fear-inducing headline right there in relation to tariffs. So here you can see the core and CPI upticking a little bit, which is leading everybody to be a bit concerned. But core really holds the clues, in my humble opinion, when you exclude the volatile food and energy categories, which can have a little bit of seasonal impacts on them. Let's have a look down here, yeah? So apparel prices rising 0.4% for the month, but we saw they're still net negative in a deflationary environment, while footwear saw a 0.7% increase after several months of decline. Apparel and footwear, those are two things that will be affected by tariffs, and we covered that a few weeks ago when we saw the average price increases to them on a quarter-over-quarter comparison being roughly anywhere between 4 to 6% of the price. So we're not seeing increases of 30 to 50% on shoes and t-shirts and stuff like that, but it is slowly making its way to the prices that consumers will have to pay, right? Now, here's what one analyst had to say, and I think he pretty much hit it on the head. Tariffs usually take time to show up in inflation data, and because many imports were front-loaded, so companies built up a lot of inventory leading into these tariffs, right? Only a limited number of goods may have been affected so far. This is true. While any inflation bump from tariffs is likely to be temporary, and I do agree, the recent wave of new tariffs suggests the Fed would be wise to hold off on policy changes for the next few months, which is why you saw a big upswing today in interest rates, especially the longer-term portion of those yields, right? And why a lot of the interest rate sensitive sectors have declined. Now, here you go, where inflation is and isn't. Here is the main component that I want you guys to pay special attention to. It is monthly earnings. This is people's salaries, how much they've gone up over the past 1 year. Overall, you would like to see most major categories below this, preferably below the overall rate of inflation. This is true, but it stands to argue if your average hourly earnings have gone up by more than most categories, you are gaining pricing power back over inflation. I know it doesn't seem like that. I know this is a very slow effect, but what would you prefer, right? Would you prefer average hourly earnings to be all the way down here at 1%? Then you'd be losing net purchasing power. So you can say that consumers are gaining, albeit slowly, purchasing power over the overall rate of inflation. Household energy still remains your main contributor right here on a year-over-year basis. Most of that was last year. It's been coming down. Auto insurance, same thing. Most of those gains were had last year. They're now winding down. Housing, restaurant meals, rental cars, and rent still remain above average hourly earnings and above the rate of inflation overall. Personal care, used vehicles, medical care, still also above the rate of inflation. But look at all the categories, important categories, that are actually below the overall rate of inflation. Groceries, that's a very important one. College tuition, also a very important one. Recreation, I mean, do you guys like going out or not, right? That's down 2.1%. Pets and pet care, alcohol, new vehicles. Furniture, another big one that's supposed to be affected by tariffs. We haven't seen it just yet. Moving on further, prescription drugs, that's another big one. Toys, if you have some kids, and appliances. So a lot of very important categories are below. And especially this one right here, gasoline, guys. That's a very big one for people's wallets on every single week, per se. Airfare, electronics, also big ones. Hotel rooms and clothing overall. Transportation too, if you take public transportation or whatnot, or even for trucking companies, the cost of transportation is actually down. So at least that doesn't have an inflationary impact on some of the goods that you are paying that are being transported logistically, of course. Here's a further breakdown here of several major components. You can see apparel is overall getting cheaper in relation to the past 12-month change in price. Recreational books, this was funny. Girls' apparel is down 2.9, but boys' apparel is up 2.4. So I guess they net each other out. Airfare, good if you want to travel. Lodging at hotels and motels, that is also down. Bicycles down. Gas prices there as well. And here to the upside, guys, some upswings in consumer discretionary items. Video and video game subscriptions up 13%. Ground beef up 10. So I guess it's going to go from $5 a pound to $5.50. That's not really going to break the bank, but still, it's right there. Textbooks, candy, and gum. Okay, chicken up 3.9%, not a very steep increase, but still every little bit matters. And then you got food from home and fresh fruit. So you might think that because of the food increases, that, you know, the food increases are possibly because of the tariffs. You would actually be mistaken. You just have to ask AI about this. How much of its own food production does the US consume? Well, as a matter of fact, guys, the US consumes 80% of its own food production. The only significant things that it imports truly are about 60% of fresh fruits and 40% of fresh vegetables. They do produce the balance. So overall, you can see some upticks there. But at the end of the day, right, are fruits and vegetables the largest components of people's grocery shopping list? Probably not, but at the end of the day, they do have an impact here. You guys consume most of all your meat and dairy overall. And in terms of the overall food supply, the US imports about 15% of the total food supply. So tariffs are not really the common theme here for increases in food production overall. Now, those are the headline numbers, and you may deem that, well, maybe the CPI is not the best way of measuring inflation. And I would tend to agree. So we can look to a more a transparent piece of data right here, which is Trueflation. This measures 30 million different items from over 80 plus different sources, meaning big box retail companies, right? And you can clearly see here that on a 1 month relative basis, well, I'll show you the 6 months here, it peaked. Here's your month of June, yeah? Starting all the way down here at 1.85. It came up, so normal to see some increases in CPI. But what's been happening since the end of June? We've seen a clear drop pretty much all across the board. And once again, this measures 30 million different products, right? 30 million items from over 80 different data sources. So if you don't believe CPI, maybe you can give a little bit more credence to this value right here. So we can kind of take Jerome Powell's words to the bank at this point in time and say, you know what? Inflation is still on a nice downtrend, but it is going to be bumpy. I would not deem that this month's increase is enough to kind of set a tariff narrative off. Of course, the media and the markets are going to react to this immediately and jump to the worst conclusions, but we can't really derive that there's an inflationary trend, especially since we have some data points right here that would show that it has been decreasing since the onslaught of the month of July, right? So that's the read on CPI. I don't think you should read too much into it. Of course, after a day like today, it is going to impact the markets to the downside. But when you really drill down and look at the data and different components, you can see that we don't really have that much information on whether or not tariffs are truly putting the consumers at risk, at least right now. You may have to wait a couple more months for that. So that's the analysis on inflation. Hopefully you guys enjoyed that. Now let's jump into some bank earnings, shall we? And we're going to start off with the biggest one of the bunch, and that's going to be JP Morgan. So JP Morgan today coming down about 0.74%. They actually had a pop initially on earnings, but then sadly came down with the rest of the financials industry. Why? Well, I mean, look at these earnings, guys. They went very well, right? 16.88% on beat on EPS. That is fantastic. And a 2.51% beat on revenue. There's a few key things that we're going to take away from JP Morgan. I'm not going to dissect the entire bank earnings. We just want to know a couple key elements, yeah? Are they well capitalized? In the event that the banks go into a credit crunch cycle, are they well capitalized, and are we at a risk such as 2008? I'll just give you guys the hint. The answer is no. And number two, how are consumers doing, right? Are they defaulting on loans left, right, and center? Are commercial loans as well being defaulted on left, right, and center? The answer there as well is no. So let's have a look at it here, shall we? JP Morgan Chase tops estimates on stronger than expected trading and investment banking. That's curious because initially, about a quarter ago, People were saying that because of the quote-unquote death of U.S. exceptionalism, there was no M&A deals and investment banking would probably be down over the year. That's not been the case. There was an initial shock where people were reluctant to go through large deals, but all of that risk has kind of been taken off the table, and now you are seeing stronger than expected trading and especially investment banking with a lot of merger and acquisition deals going through. So here's what JP Morgan had to say. The bank said that second quarter earnings fell 17% year over year. However, last year it realized an incredible gain on Visa shares by 7.9 billion. So this number is somewhat skewed. Their earnings were actually positive year over year if you were to remove the impact of that Visa number. Revenue fell to 10% to 45 billion. However, the comparison with a year ago was also impacted by the bank's Visa stake. As a matter of fact, revenue was actually up year over year, not by that much, by about 2%, but that is indeed standard for JP Morgan. This bank usually only moves up about 2-3% per year. So once again, no red flags there. Here's what Jamie Dimon had to say. He touted his bank's results and ability to boost dividends and repurchase shares. Still, Dimon also repeated his frequent warnings about the risks from U.S. trade policies, overseas conflicts, and rising fiscal deficits. I'm going to tell you guys, I've been listening to JP Morgan earnings calls for years. I literally cannot remember, especially over the last 2.5 years, I cannot remember a earnings call where I've heard Jamie Dimon be positive about the status of the economy. But then again, that is kind of his job, right? I used to work at banks. I know how they operate, right? That is the bank's selling point for you to invest your money with them, right? Everything is very tumultuous in the economy right now. There are several risks that you may not understand. So please deposit your money with us and we will keep you safe, right? So it kind of is his job to be on the more defensive side. As I said, I have not heard him have a positive tone on the economy, not just since the Trump administration, but even in the last 2 years of the Biden administration too, right? Here's what he had to say today. The U.S. economy remained resilient in the quarter. The finalization of tax reform and potential deregulation are positive for the economic outlook. However, significant risks persist, including from tariffs and trade uncertainty, worsening geopolitical conditions, high fiscal deficits, and elevated asset prices. So once again, quoting the balance of risks. Tariffs are a risk to the consumer, but on the other hand of that, we got a lot of tax reforms, a lot of tax cuts, and deregulation to corporations. Curious to see if those are going to offset each other. That is what he's saying right here. But once again, predicting the final outcome is a little bit challenging, even for someone like Jamie Dimon. Moving forward, fixed income trading revenue jumped 14%. That was very good. Equities trading revenue jumped 15% additionally. Very good. Obviously, a lot of people coming back to the markets now that we're through most of the tariff drama. Investment banking rebound as well. Banking fees for investment banking rose 7%. That was very solid. Could give us an indication as to the Goldman Sachs and Morgan Stanley earnings tomorrow, which, if JP Morgan is anything to go by, should be pretty good. JP Morgan's results in the quarter were also helped by its $2.8 billion provision for credit losses, which is better than the $3.14 billion expected by analysts. This is how much money the bank is putting aside for credit losses, right? Defaults on people's loans, namely consumer loans. Is this number going up or down? It's going down, actually under the analyst's expectations. So it stands to argue, if Jamie Dimon was so nervous, and keep in mind, it's not his decision, he has some input. This is all derived by algorithms that derive the credit risk to the bank and then adjust the credit loss provisions accordingly. If there was deemed to be material risk to the bank's credit assets, you would see these provisions going up. They have not been going up. They've been going down steadily for the past 3-4 quarters, and we cover this every single time on the channel, and it's been a common theme over the past 4 quarters. So despite the warnings of guidance that the bank is giving, it's not actually doing that on its own balance sheet, right? So keep that in mind. The bank also boosted its guidance around net interest income for the full year to roughly $95.5 billion, or about $1 billion more than an earlier forecast. So they are doing better on net interest income. All in all, it was a great report for JP Morgan. However, still keep in mind, guys, since the last quarter, since the tariff lows, this bank was up 42%. And as I was saying yesterday, leading into this earnings season, pay special attention to all and every company that looks like this. Very, very nice performance. They will have to justify that performance. And if there is anything that Wall Street can pick apart from this report that they don't like too much, such as Jamie Dimon's words on guidance, well, it will be a catalyst to possibly start a little bit of a keyword healthy pullback. So that's JP Morgan's earnings. We're going to take a look at Wells Fargo and see if that's the same. Oh, sorry, before we do, guys, I just want to show you, this is not my interpretation, right? Look at their return on capital employed, 21%. That is fantastic. CET1 capital ratios, are they well capitalized? Absolutely, 15%. The regulatory minimum is 9.7, so they're 50% above the regulatory minimum in terms of capital requirements. That is very good. You can see cash and marketable securities is set at 1.5 trillion, above their average loan balance of 1.4 trillion. You can also measure that with something fancy that you call the liquidity capital ratio for the bank, which is the LCR. Anything above 100% is the regulatory required minimum. So that is very good, in or above their amount of loans too. And we can take a look as well at some of the consumer and community banking performance here. Net income for consumers and community banking up 23% in terms of profits. Revenue was up 6%. Expenses were up 5%. So they do have a bit of operating leverage right there. Debit and credit card sales volume was up 7%, and client investment assets up 14% year over year on the commercial side and 7% quarter over quarter. Definitely not a bad quarter for them. Do you guys see any red flags just yet? I don't either. Card services net charge off rate. So the amount of people that would possibly just stop paying their credit cards. I know there's been a circulating headline for the past 2 years at this point. Credit levels for the consumer are unsustainable. Well, in that case, the bank would be putting more money away. And it's not as if they don't have the knowledge to do so, right? It's not as if they're doing this on purpose and being greedy. They have stringent capital requirements, guys. They're not trying to be too greedy. They will uptick this if they have to. 3.4% is the card services net charge-off rate, which is actually lower than last quarter and also lower than 2Q of 2024. So year over year and quarter over quarter, that has actually come down. All in all, a good quarter for JP Morgan, guys. Nothing bad to say. No red flags in my humble opinion. That's all we had for JP Morgan. Now, in terms of Wells Fargo, guys, Wells Fargo profit beats estimates. Cut to net interest income forecast weighs on shares. Now, this is specific to the bank. JP Morgan did a good job, but this bank has some little items that are specific to them that are impacting their ability to guide higher for net interest income margins. So that being said, that is why you saw Wells Fargo Corporation drop by about 5% today. It's not because the consumer is not healthy. It's not because they're issuing massive warnings. No. It's because of things that they could have very well controlled. They just didn't manage too well in the past couple of quarters. Let's move on to it. Beat second quarter profit estimates on Tuesday, but cut the 2025 guidance for net interest income. And the cut wasn't even that bad, guys. Just going to show you what we had this quarter overall. Yeah, you're looking at a 13.5% beat on EPS. Fantastic. And a nice little beat on revenue here by about 1/3 So let's look into what they could have done better. The bank expects its interest income to be roughly in line with the 2024 level of 47.7 billion. In April, they said that the growth would be at the lower end of 1 to 3% range. Sadly, right now, it's going to be roughly in line, barely 1% growth. So that's why they're kind of missing on guidance. And this is the most important factor for a lot of banks out there. You have to beat your NII numbers, or Wall Street's just not going to be too kind to your share price overall, yeah? They said that the lower interest income in it was due to the markets business overall. This is something that was within the confines of their control. Loan origination was pretty good for them overall. They're just not doing the best in their markets business, something that JP Morgan actually smashed in terms of client volumes, yeah, trading on margin and driving loans, lines of credit, stuff like that. While there continue to be risks, here's what the CEO had to say. While there continue to be risks, activity levels have remained consistent, and our strong credit performance continues to point to the strength of our commercial and consumer customers' financial positions. Provision for credit losses once again fell to 1.01 billion in the quarter from 1.24 billion a year ago. So if things are about to hit the fan, you'd expect them to put more money on the sidelines, right, for credit loss provisions. They're actually not. It's actually getting reduced right there. Again, similar to JP Morgan, it's a common theme, and it has been a common theme over the past 4 or 5 quarters. Investment banking fees rose 9%. That was very good. Once again, giving us a hint into Goldman Sachs and Morgan Stanley's earnings for tomorrow. Last month, the U.S. Federal Reserve lifted Wells Fargo's 7-year-long, almost $2 trillion asset cap, allowing the bank to pursue unimpeded growth. That's going to be good for them in the medium to long-term future, of course. Here's what the CEO had to say. We now have the opportunity to grow in ways we could not while the asset cap was in place and are able to move forward more aggressively. That's one thing, but the Fed also about 3 weeks ago, removed liquidity requirements in terms of the SLR. That being said, the banks will be able to invest more money in their own share buybacks, possibly pursue, more equities purchases or more U.S. Treasury purchases as well. So all in all, a good thing for them. In terms of their quarterly earnings, guys, we're not going to go through too much. I just want to show you the health of the consumer, right? Allowance for credit losses for loans, right? So we saw that the provision for credit losses is down from 1.3 to 1 billion year over year. The allowance for credit losses overall, commercial and consumer, are 14.6 billion. That is down 1% as well. So obviously the bank is pretty comfortable with its numbers. CET1 ratio of 11.1, the regulatory minimum is 9.7. This bank is also well capitalized, and the liquidity coverage ratio of 121%. Both of these are the most common, the ones that are most common used when deriving the health of a bank overall. That being said, guys, we're not going to go through these slides. You guys can do that on your own if you want. We just want to derive the health of the consumer, because the narrative right now in the market is the consumer is going to fall off a cliff, et cetera, et cetera, et cetera. So we want to know if it's happening right now. If you look at these bank earnings, it's actually not happening right now. Credit quality, net loan charge-offs, you can see that they've been decreasing those requirements here over the past 5 quarters, as I was saying previously. So I'm not just talking out of my hat. It's actually happening. You can see that very clearly from this chart right there. The allowance for credit losses for loans as well have been steady and maintained. But in relation to last year, they are down by about, like I was saying, right, by about 1% overall. So not that bad, all things considered, guys. I mean, Wells Fargo had decent earnings, but some of the things that they lost on in terms of net interest income guidance were, you know, kind of well within the range of their control, but nothing bad here. All things considered, these banks have run an absolute ton since the April lows and are just now looking for some possible healthy pullbacks, but I see no red flags with these banks overall. We'll get to hear from more banks tomorrow, of course, as tomorrow we get Bank of America, Goldman Sachs, and Morgan Stanley, and I'll do my best to cover those on the channel at that time as well. So that being said, that wraps up our inflation segment and also our banking segment. Hopefully I was able to answer some of the burning questions that you guys may have had. Now let's jump into some charts, shall we? All right, so now taking a look at the SPY, guys, down about 0.43%. Oh, just before I forget, we will go over the China news at the end of the video there when we cover the biggest gainers and losers of the day. NVIDIA will cover this news when we go over NVIDIA's chart in the big tech breakdown there in NVIDIA's own section, right? But for now, we're going to focus on the indexes. So as of right now, clear pullback day. But what have we been doing, guys? We're basically just stuck at the all-time highs right now. You can see it best on the futures. We're literally just stuck at the all-time highs, and we've been here for the past 2 weeks as money kind of sloshes around. Some days value outperforms, some days it gets really concentrated into tech. But overall, I don't really see any major red flags. I will bring your attention to this level right here, 618. If you lose 618 without setting a new all-time high, that's a daily downtrend. And then thereafter, guys, you just have to go one time frame higher, right? When in doubt, just zoom out. And who's in control of this time frame? It's very obvious that it is the bulls, right? So even if we do get some drawdowns throughout the rest of the week, keep in mind the rest of the week, guys, we have a couple things to watch out for tomorrow. Producer price index. On Thursday, we do get retail sales as well. And the rest of the week is, earnings filled too. ASML tomorrow for semis. Thursday, you got TSMC. Thursday as well, after the close, you got Netflix. And tomorrow, the rest of the banks overall. Those are going to be the biggest earnings releases. So they could send us either way in the event that everything is bad. Well, you're just going to come back here into support, which is pretty much 609 to 599. And the weekly higher lows are all the way down there. So the bulls have a lot of space to work with overall. Keep in mind that July is supposed to be seasonally bullish. And before the month ends, you will be getting all or most of all the earnings from the big tech companies too. So keep that in mind, guys. The SPY right now is not looking too bad, but I will be a big fan in the event that we do kind of unravel the time frame right here. I'll be a big fan of trying to buy some of these dips, not only on the indexes, but you guys know me. I'll be targeting some individual stocks, and I'll keep you guys updated on the trades that I'll be making for those as well. But I've been waiting for these pullbacks. I got a lot of buying power in the account, a ton of buying power, as a matter of fact, and hopefully you guys do too. Moving on to the QQQs right now. QQQs down, or rather up, down 0.09% to the upside right now, but same thing on the Qs, right? We hit a new all-time high this morning with the NVIDIA news, and now just pulling back and trying to go for the little bit of a gap fill. You can see here's the gap up, fill the gap towards the end of the day. So in the event that we do decline, guys, you're looking for some higher lows, right? Anything about 550, just still looking for some small incremental higher lows, and possibly will proceed higher. That being said, if the rest of tech earnings this week are bad, let's say we get some bad price action from ASML, TSMC, that leads semis into a downswing. Netflix comes out bearish and leads into a downswing for some of the big tech companies that have ran very hot. Well, guys, there's just going to be unwinding this. You might just be going into a loss of the daily uptrend, opens up the door for possible downtrend. But overall, guys, right, The short-term price action on the daily is very choppy right now. The cleanest time frame here is, of course, the weekly time frame where the bulls are still in full control, and any move lower just going to be looking for a higher low. Anything above 524 looking for that higher low. Down below here, very nice support, 537 down to 525 prior all-time highs, and the 12 EMA sitting pretty comfortably in that location too. Moving on to the XLF right now. So XLF down 1.71, and it wasn't only the banks, it cascaded into everything, but a lot of that also had to do with the very rapid rise in yields that we've had not only today, but also the past few weeks as we've been talking more and more about tariffs, which kind of leads, carries into the narrative. Maybe the Fed is not going to be in a rush to cut interest rates, et cetera, et cetera, et cetera. These yields are going to be very volatile, but overall, I think most of you can understand by now, right? We are going into a rate cutting cycle. It's not a question of how much, it's really a question of when, and that when is probably going to be September and December overall, and then a few more leading into next year too. So, at least you're going into an interest rate cutting cycle. And as many analysts and even the Fed have said, any increases in tariffs will probably be temporary in nature. So I'm not too concerned about that. And after today's beautiful bank earnings, I'm also not too concerned for financials, all things considered. But, we had a very beautiful rally into new all-time highs, as you can see on the weekly. And now just a bit of a daily downtrend, which is completely normal price action, right? So daily downtrend right now, any bounce going to be looking for a lower high and then maybe a lower low. That is, of course, until the bulls get a nice bounce going and can reset the daily uptrend. We're right now looking very simply for a weekly higher low. It's a beautiful weekly uptrend right now. Yeah, looking for a weekly higher low. Anything above 49.80, looking for that weekly higher low. A lot of support right here, the prior all-time highs. Maybe for some consolidation and maybe before the banks bottom out, give back some of their beautiful gains. I mean, look at JP Morgan and Wells Fargo, right? It's so extended right now. A lot of the banks are just very, very, very extended, just with some natural pullbacks. We'll see if that same thing happens to Bank of America tomorrow too. We got Schwab on Thursday as well. Schwab's been performing insane, right? You look at the investment banks too. Morgan Stanley, beautiful push to the all-time highs. Healthy price action on any downswings. And, Goldman Sachs may be the same. Even if they do have good earnings, I would not be surprised if even good earnings are taken just the way the bank earnings were taken today and provide a little bit of an opportunity for a pullback. Everything was kind of running hot in the sector, so you're just getting a natural pullback. In my opinion, guys, no red flags. The monthly timeframes also hold the key. It's looking quite bullish for some possible expansion. Even if we do have a bit of consolidation here, for some expansion throughout the rest of the year, I would not be too concerned with this chart just yet. Moving on to XLV Healthcare. Unfortunately, healthcare being the unfortunate beneficiary of some pretty bad news. And once again this morning, it had to do with a lot of the healthcare insurance providers and some more worries about sectoral tariffs on pharmaceuticals, which we brought up last week. That being said, daily downtrend is in motion right now on healthcare. Again, just cannot seem to get it done. The weekly, though, is just in a very awkward style of consolidation range. The clearest time frame, in my opinion here, guys, is the higher time frame. It's been very choppy. Pharma sectoral tariffs, health insurance providers falling off an absolute cliff all year, all things we know already, which has led to some pretty significant underperformance by healthcare, at least recently, right? We're coming down into a big area of support. We're still there. We've been here for 3 months, yeah? And that's 136 down to 122. I'm still a fan of bidding healthcare, but as I've said many times, as I have been in this position too, that I have built at the lows, you have to be very patient for this one. The divergence between healthcare and the SPY, if you just plot the SPY here, you'll notice a very, very clear divergence, yeah? A very clear divergence down on the healthcare sector and up on the SPY. Usually that does not last forever. You can see that it doesn't usually diverge like that, right? Here we have a bit of a downswing on healthcare and the SPY was uptrending, and eventually they kind of met somewhere in the middle and did resume trending together. This divergence is one of the more pronounced ones that we've seen in recent memory. So I'm a big fan of buying that divergence. It's going to take a while to turn around. It's kind of like trying to turn around a cruise ship or trying to turn around a freight train. It doesn't happen boom on a dime, but eventually, in my opinion, it will happen. So we just got to remain a little bit patient and have a bit of conviction that the healthcare sector is probably not going to go into a multi-year downtrend and, fall off the face of the earth here and go down like 50% from the highs, right? Moving on to SMH right now, SMH up 1.92%. Obviously, that had to do with NVIDIA's news. I mean, let's just cover NVIDIA's news right now rather than doing it then. NVIDIA saying it's going to resume H20 AI chip sales to China soon following U.S. government assurances. I'll remind you, the U.S. almost blocked NVIDIA and other players such as AMD from exporting chips into China, establishing more and more export restriction controls. In April, they told NVIDIA that it would require a license to sell the chips to China. This resulted in NVIDIA taking a $5 billion markdown on their previous earnings. All things considered, the US government has now assured NVIDIA that licenses will be granted, and NVIDIA hopes to start delivery soon, possibly once again unlocking a $50 billion market segment for the company. We know that last week, Jensen Huang, it doesn't say it in this article, but if you guys are paying attention, he visited the White House last week. So we know that, here it says he's ramped up his lobbying efforts against export controls. So possibly his most recent meeting with the president did unlock the news that we had today. But that was the one thing that sent a lot of the names in the sector higher, namely NVIDIA and AMD, which was also subject to those very same restrictions. So some very nice performance on a few key players. But you'll notice by this this name list right here, not all names in semiconductors were up the same today. Largely up were NVIDIA, AMD, and Broadcom, right? Who have some of the most possible sales pipelines, or some of the largest possible sales pipelines towards China, yeah? That being said, semis are up 1.92. Big gap right now, and the daily bulls are in full control. I've been saying this for a while, guys. If you really want to see the SPY embark into large weekly consolidation, you have to lose your lead bull. Until you lose the lead bull, guys, it's just not going to happen. It's just going to be this funny game of rotation on and off again. That being said, semis are not looking too bad. Daily uptrend is very clear right now, with the higher low being set at the low of yesterday, 282. If you unwind and engulf and go into the daily downtrend, is it that big of a deal? Is it over? Is the entire run on semis over, guys? Probably not, right? Taking a look at this chart right here, looking very strong. The weeklies in full bull control right now. We are getting a little bit overbought. So if we do get a pullback, maybe some catalyst for a pullback could be a response to ASML and TSM earnings. If they are underwhelming, which would be surprising if you ask me, right? But maybe like the banks, TSM has run a ton. We covered it every day. TSM has run an absolute ton, right? Even though their numbers could be very good, like the banks, maybe you get a decline, right? ASML, though, ASML has been somewhat underwhelming. So I wouldn't be surprised if they have good numbers, the stock might actually go up, because even though it's up from the bottom, it's not anywhere near to super bullish sentiment on the company right now overall, yeah? So keep that in mind on semiconductors, guys. If you do get a weekly pullback, first stop's going to be your prior all-time highs, 275. And if it really sells off hard here over the next few weeks, which would be surprising, the next big area would be 260 down to 250. I would be sitting there for short puts, maybe not on the index, but on individual companies that have ran a lot. We'll talk about those when we talk about AMD and NVIDIA later on in the video, of course. IWM Russell, well, of course, on a day where yields are skyrocketing, the Russell is not going to have a good time, down 1.96% today, and right close to unwinding the daily uptrend. Daily uptrend was very nice and pronounced right there. Reaction from resistance range, which was 230, 232 down about 226, let's just call it, right? It's a big level for IWM, all things considered. Take a look at this, right? Very big level of resistance. That was the 2021 highs and some of the highs that we had back here. So obviously, with the concerns around interest rates and inflation, et cetera, the growth sector is not going to perform the best. But the clearest price action for me, if we lose this and go into a daily downtrend or just flush from here, right? Support below 216 down to 207. The cleanest time frame, in my opinion, still remains the weekly charts right now. Not looking too bad, just looking for a weekly higher low, anything above 207. Higher low, and you got all of this support area to kind of set and establish some more consolidation within, right? That being said, that's everything for your major sector rundown. A lot of your minor sectors were down as well, but they're just kind of interest rate sensitive, right? Anything in inflation-wise in relation to the consumer and tariffs, and then, industrials and real estate utilities, those are interest rate sensitive, just flat out. So they're not going to have the best day at all. Moving on to the VIX, funny enough, even though you would assume with a bright red market like today, the VIX would be up substantially. It's actually not. So it just goes to show you that, when you really look under the hood, was today really a bad day or just maybe an excuse for some consolidation? In my opinion, just an excuse for some consolidation. Now, the consolidation can last for more than one day, but I've been very clear on this, yeah? If we have an uptick on the VIX, it's going to be a phenomenal, well, usually when you have an uptick on the VIX, the markets are plunging at that time. And any pullbacks, in my opinion, because the bulls control the higher timeframes, weeklies and monthlies on most of your major indexes, they should be quite good buying opportunities, all things considered. So I have a lot of buying power, especially for this earnings season, for anything that drops, even though their numbers are good, which would just be a price action and technical pullback. I have a lot of buying power for those types of plays. So just take a look on the VIX, and if it has an upswing there, it could be quite interesting. Yields we talked about prior. You'll notice here that we're once again back to the pain point, which is 4.5 on the 10-year and above 5% on the 20-year yields. Of course, today, is just 1 day of data. You know, I think we're really going to be confined here, probably between the low 5% range and the higher end of the 4% range for a while until we get closer to rate cuts. You know, we'll have macro releases every now and then that pushes these down, and then other ones that pushes these up. You know, you really got to get a clear-cut rate cutting cycle and a better idea of what the actual impact on inflation is going to be. Because when you get the actual impact on inflation and for how long from the tariffs, well, then you actually get the true Fed rate cut path cycle. Yeah. So keep that in mind. Bonds are going to be a very tough trade, guys. It's an accumulation trade. So if you're accumulating shares, you probably have no issue. But if you have some call options, you probably want to have a lot of time on those calls to really let it expand through the next, 6, 9, 12 months overall. That being said, that's everything for our overall market rundown. Take a look at gold real quick. Gold up 0.05%, but I keep doing that because gold closes the day right before I film these videos. Gold was actually down 0.56. Gold is doing literally nothing, guys, right? It's been doing nothing for a while. I mean, you can argue that there's some trends within the confines of this range, and this is true. But overall, they were kind of trendless on gold right now. So right now, we're just looking for a higher low, anything above 32.84, looking for a higher low, kind of coming down into support. Maybe if it comes down into support, I will play this one once again from the bottom to the top end of the range and try to play some range bound action with the stop loss maybe below the support range overall. But overall, we're just lacking any trending nature right now. And of course, if we want to build some shorts, you can make an argument that you can possibly build some shorts and go for it here. If that's your style, if you're looking to go for that, your stop loss would be above here, 33.78. And then, of course, you'll be targeting levels to the downside such as a breach of 32.51. And your thesis would be, as more money is sloshing into equities right now, it may just be the time to pump the brakes on gold and go for some much needed healthy monthly consolidation after like 7-8 months of being overbought. The monthly time frame eventually will have a pullback. And if that's your thesis, that might be a trade that would interest you. Moving on to Bitcoin right now. So Bitcoin down 1.92%. What happened to Bitcoin today? It was down almost 3% on the day. Well, it was a question of, wait, I don't have the article pulled up, but give me a second. So it was this piece of news right here. Bitcoin falling below 117 after Trump crypto bills are blocked before the vote. You might remember the president saying last week that he wanted to make the United States the home of crypto and the best place to do crypto in the entire world. Unfortunately, a series of crypto-related bills, which are supposed to increase exposure and decrease some of the regulation around crypto, sadly did not pass in the House, 196 to 223. So, of course, that had a bit of an impact on not only Bitcoin overall, but on several of the interesting names in crypto, namely some of the Bitcoin miners. Coinbase was down, Circle was down as well. So that was a piece of news for the day. So unwinding a little bit of bullish momentum right here. But who's in control of the chart, guys? It should be fairly obvious, yeah? Daily uptrend right now, looking for a daily higher low. Anything above 107.5. Looking for a daily higher low for possible further trend continuation. There's two things that can happen, guys. Either we come down into the 12, sit on the 12 EMA, which we've been holding a lot recently, yeah? Come down and sit on the 12 and maybe go for another upswing. However, if you take back too much of this move and open up the door for the lower high into lower low, well, that'll be a daily downtrend and it will just be synonymous with weekly consolidation. Good thing the bulls are working with an absolute ton of space right now. Beautiful accumulation. The higher lows are here. 98,300, looking for a higher low for further trend continuation. If you come back down all the way into a daily downtrend, the closest area of support is the area of resistance that we just broke through, right? 111.5 down to 109. That could be a very decent area for a weekly retest to build some more swing trade longs if you're looking to further position in Bitcoin as an asset overall. So please keep that in mind. Moving on to our big tech names now. So coming into Apple right now, Apple is up 0.23%. But before I get into Apple, because I know that a lot of you guys skip to the stock specific segment of the video, I'm going to just say one thing about days like today in the markets, yeah? What we have to do, guys, is start to distance ourselves from the following psychology, yeah? On big green days, we say, it's going to the absolute moon. On big red days, we say, it's absolutely over. We need to stop thinking in the terms of extremes. It just leads to bad trading habits overall and bad psychological habits too. As traders, not talking about long-term investors, because you guys are just buying the dip with, or just DCAing with your paychecks into your long-term portfolios, right? But if you're looking to trade the markets, you have to really get outside of the sensationalist narratives that can be at hand and just observe the data and observe the market narrative for really what it is at hand. Show up to the markets every morning, come to the markets with a clear head, and stop trying to speculate. Let the price action dictate what the direction of your trade is going to be, right? The more that on green days you say you get excited, super excited, it's not going to be conducive to good trading habits. The more on big red days you say the entire move is over, it's not going to be conducive to good trading habits overall. So that is my kind of tip of the day, guys. As traders, you have to be stoic. Approach the charts every day with a clear and level-headed mindset, and your results are going to improve over time. So taking that in consideration, guys, moving into Apple right now, Apple rejecting from resistance once again, 221 down to 211. Daily downtrend is somewhat likely right now if the markets continue to bleed. Keep an eye on this. 207.73 is your daily higher low area. If the bulls are able to save this, they could just push into a new high. But in the event we unravel here, is it over? No, you're in the confines of a very big range right now, and who's in control, short term at least, is the bulls. Nice weekly uptrend, just looking for a higher low on Apple. Anything above 195 looking for a higher low. I'll be looking at position, guys. If Apple unravels here again, you might see me with some leap call contracts. If I can find in the lower 200s on Apple, you might see me start off some leaps, as I do believe there's some good risk to reward here. Apple once again being down year to date by about 15-16%, severely trading the indexes. And at the end of the day, I know Apple's been having some problems with the tariff headlines, some problems with the iPhone refresh cycle headlines, some problems with the AI headlines as well. But at the end of the day, guys, Apple is a phenomenal company. It has an ecosystem that is arguably second to none on the entire planet. Very sticky business model, very high client retention rate as well. And just keep an eye on the weekly timeframes here and play the levels, right? Comes down really sharp. I'll be looking to sell puts at support, which is roughly under 200, 196 down to about that 188 level. Apple has earnings in about 2 weeks time. So curious to see how the price action evolves into that period, right? Moving on to AMD right now, being the beneficiary of the NVIDIA news, of course, because they do export. Well, at least they did before the restrictions were on. They do have a lot of product going out to China, to be specific, around 8% of their business. It's a big piece of news for them, right? Up 6.41, clearly smashing through our resistance range. 153 down to 145 was that resistance range. And when you want to smash a big level, sometimes you need very big candles. And today definitely was one, although there is a very big gap. I cannot close this box green for support until we close this weekly candle, because if we give it all back, then that's just going to be a rejection once again on the weekly time frame. Sorry, I'm swapping too often. You guys maybe are going to have some seizures or whatnot. You know, if we come back below, that would be unfortunately a fail of resistance, and you might just be looking for higher lows. But as of right now, AMD is looking very solid. The daily bulls are still in control of this time frame. A little bit of a daily downtrend right there, a little bit of a weekly consolidation phase. Now you get the extra leg of expansion, looking very good. Weekly not yet overbought just yet, looking good for some follow through. But even if we don't get the follow through, guys, if you guys are wondering whether or not it's a good time to buy AMD, now that they rallied 2x from the bottom, we must be late, right? It all depends on your time frame. Of course, you will not have the rapid gains, the 2x gains that you've had on AMD. You're not going to get that, right? In the next quarter, AMD is probably not going to 2x again. So the period of rapid gains is probably done, but that doesn't mean that the overall total gains are concluded just yet. AMD's valuation is still pretty good, and they have still not truly embarked on their cycle, right? The cycle is going to be over the next 2-3 years of increasing EPS by a substantial margin, guys. This company is going to 3x EPS in the next 4 years. And in terms of revenue, they're going to 2.5x their revenues. So all that being said, that is probably not priced in, especially not at these low valuations. So even here at 155, is it a bad time to open an AMD share position? No. Is it the most optimal time as it was down here? No, but it's not a bad proposition overall, right? If I had to build a position on AMD, even here, right? Now let's say you're convinced, well, I would start small, and if it does unravel here over the next few weeks with, let's say, a market pullback, I would just be building and DCAing with that long-term 2-3 year thesis. So keep that in mind. Moving on to Amazon right now, up 0.29%. Amazon trying its best to get above the resistance range. We are almost there. 227 is the top end of that. Daily bulls remain in control of this chart. Your higher lows are now set at 219. Any pullback looking for a higher low and possibly get a little bit more momentum before coming to the upside. That is if we don't just smash it right away. Two trade styles, in my opinion, right here. One of them would obviously be the breakout and retest. If you get a breakout retest, guys, keep it on the weekly timeframes, yeah? It'll be very nice. The bulls are in full control of this chart. Let me make this a bit bigger so you guys don't go blind. So that'll just be a breakout here. Very beautiful bull breakout. Beautiful daily or weekly uptrend right now. Looking for a breakout, retest and run. That retest right there, once they've claimed the area, could be a nice opportunity for some swing trade long, so like short-term call debit spreads and stuff like that. They have their earnings coming up in about 2 weeks worth of time, so keep that in mind. The other trade, of course, is in the event that we just start plunging very rapidly. I'll be looking to sell puts as close as possible to 210, which is your weekly higher low, and closer to the support range, building some swing trades again from down here in or around the EMAs, which again is the, short-term moving averages for the company. And all in all, guys, Amazon right now at 225, the valuation is not too bad. They should be expanding well over the course of the next couple of years. Moving on to Google right now, Google up about 0.16%. Google, Google has been kind of out of favor for a while, but now it's actually been one of the better performers over the past 2 weeks. Looking very good there. Daily uptrend is once again in motion. Resistance stays planted 190 to 184. If we fail this, the higher low is right here, 174. Maybe grab a little bit more momentum down there from these recent highs, right? Bit of a pullback, back test the highs, and maybe try another attempt at it. In the event you unravel, though, and go into a daily downtrend with maybe some lawsuit headlines, some church headlines, Lord knows Google has had more than enough negative headlines to its name recently, right? Well, you're just going to be looking for a bit of weekly consolidation on this stock right now. The weeklies are not looking too bad. You'll just be looking for a weekly higher low. At this point, anything above 163, looking for a higher low. The way that I would be playing this, guys, is on any sharp and fast pullbacks, I'll be looking to sell some puts down here once again on this company. I think the risk reward still for some long-term shares is not that bad. Sorry. Right? The long-term prospects of the company are looking still quite good. Fantastic amounts of buybacks, fantastic amounts of net margin, and advertising, search, and cloud have been very bullish points for the company. Moving on to Meta. Meta down about 1.46%. Meta now officially in a daily downtrend, sadly, right? So flushing these lows into the daily downtrend, which just means that in terms of the weekly timeframes, you're into a bit of a weekly consolidation phase. We're coming back into the prior support that we have. Granted, it's not a very super strong area, such as one that you would have here or one that you would have down there, but is the closest one that you have. Keep an eye on these higher lows. 680 for Meta is going to be the higher lows. The bulls are still in control, and the company has earnings coming up in roughly the next 2 weeks worth of time at the end of the month of July. In terms of the fundamentals for Meta, they are still looking very solid in around 720. The valuation is not so commanding. They have fantastic net margins, and the long-term prospects of the company are quite good. Increases in free cash flow, increases in margins, all as a byproduct of their efficiency gains. In advertising and AI, EPS should be very nice in the future, and revenue should be very smooth in the future as well. Not opposed to adding some Meta shares if we drop down below 700, even leading into earnings. Moving into Microsoft right now, Microsoft up 0.56%. Apparently, not even a red day can derail Microsoft right now. They're going to have a lot to prove to us, though, when they report earnings come in 2 weeks' time on Wednesday, the 30th of July. Why? Well, quite simply, since last earnings, guys, the company is up 31%. Now, granted, they had insane Microsoft Azure growth, right, overall, and very good free cash flow numbers, and very good revenue and EPS growth, too, with increases of profit margins. But that is a lot, right? That being said, who's in control of this chart right now? It is very clearly the bulls. They're riding the 12 EMA. So rather than trying to short Microsoft at every possible opportunity, why don't you just let the bears show you that they want to play ball, yeah? Wait for them to crack the 12 EMA, something that they haven't done all quarter. Wait for them to crack it, set the daily downtrend. Then the entry can go here. Stop loss goes above the most recent high. And then you ride the possible short for some weekly consolidation. The next possible target would be these prior highs, 467 into the 12 EMA as well. That would be a logical short rather than trying to just time the top of the market without any confirmation. The bulls remain in full control right now. I'm not adding any Microsoft shares up here. I've done my part of adding Microsoft shares all of last year at the support lows and during the tariff sell-off. I'm now holding what I have. I'm not selling anything. I'm just holding right now. Moving on to Netflix. Netflix is down 0.13%, but I mean, we can't really do too much price action analysis on Netflix, guys, for the simple fact that they have earnings on Thursday. Stock's going to move about 6-7% in either direction. 7% to the upside, right back to the all-time highs. 7% to the downside, then you got to be careful because we'll be losing the next area of support that we do have, right? So keep those two levels in mind. That being said, the daily bears right now are in control, but a huge earnings push, that's not going to matter. If we do persist on an earnings slide, right, well, then you're going to be doing a few things. Daily downtrend, yes, but also loss of the weekly uptrend. 1182 is going to be your weekly higher low. If you lose that, loss of the weekly uptrend, you open up the door for something like this. and that would just be very healthy monthly consolidation. Netflix has been up a ton since last quarter. Usually it doesn't run much harder than this in terms of extensions from the 12 EMA. Any pullback, I think Netflix is going to show fantastic numbers, guys. Can they justify this increase though? I don't know. Any pullbacks though, if they do show fantastic numbers, I will be a fan of buying. It's just that I'm waiting for something in around 1100 or less, as we have been in monthly overbought conditions now for about half a year. Moving on to NVIDIA right now. NVIDIA up 4%, looking very strong right now. I've been very clear on my thesis on NVIDIA, guys. If I have any NVIDIA shares, I'm just holding right now. I'm not adding any up here. That is a very greedy trade. I was saying this entire time. I'm not saying that if you don't buy up here, it's not going to work. As a result, it has worked. But does it build good trading habits? No. Does it build good long-term investing habits either? No, right? You've had multiple times to play NVIDIA's on the pullbacks, right? If you didn't do it, that's on you. You can't really say that anything has changed from here to there. Their earnings have been the same. They've been fantastic. It's just a change in sentiment overall, right? And don't get seduced by the changes in sentiment so easily. That being said, NVIDIA is looking very strong. Congratulations to all the bulls out there. Very happy for everybody in this stock right now. Any pullback for a gap fill looking for a higher low, anything above 151.67, higher low for possible further trend continuation. It is what it is. If we unwind and set the daily downtrend, which is always a possibility, you can't rule out that possibility, right? NVIDIA is no stranger to daily downtrends, yeah? That was ugly. This is a bit better. If that does happen, you're just looking for weekly consolidation, guys. Very, very, very simple. The weekly bulls are in full control right now. Any pullback, and you could just find yourself very close to the 151 to prior established 145 levels of support, and it wouldn't look so awkward, right? A couple weeks of pullback after such a monstrous rally. Pullback, give us some further entries for some swing trade longs. That would be a style of trade that I would be patiently waiting for. But one thing I will not do is chase up here when I'm finding so many other plays, guys, right? You don't have to be laser focused on just 2-3 names. Yeah, it's been performing well, guys. Now is arguably a time to take some of the swing trades profits off of the table. I'm not talking about long-term shares. You guys can keep those, but short-term swing trades, right? Not a bad opportunity to kind of take some profits on those and maybe wait for some rotation. Moving on to Tesla right now. Tesla down about 2% on the day. I've been very clear on this, guys. I don't think Tesla's really going to move much before their earnings coming up next Wednesday. The cleanest time frame, the daily's kind of all over the place, right? The bulls are trying, it's a daily downtrend if you want to be specific. They're trying to get it back, trying to go for the daily upswing here. But in all reality, guys, it's kind of like Apple, right? We're just consolidating, tightening up here between two ranges. Support 300 down to 260 and overhead resistance 360 to 340. I think earnings is going to be the catalyst to either send us for a break to the upside or a break to the downside. The full focus this earnings season, guys, is going to be on EPS and net margins because we know they've just lost a lot of their credits. $7,500 consumer credits for buying a new Tesla, but also the regulatory credits that they receive from other companies such as Ford and GM. Those are also out of the window after Trump canceled them because of the falling out between him and Elon Musk. So I'm not a fan of playing this one prior to earnings. I would rather wait until earnings to get a better idea of the price action and a better idea of the end of year guidance. Moving on to Palantir right now. Palantir actually down 0.38%, but Palantir set a new all-time high today before going down. That being said, very nice engulfing move by the bulls. Any move lower, looking for a higher low. Anything above 130 is going to look for a higher low to reset the daily uptrend. And in the event you give it all back and open up the door for a daily downtrend, who's in control of the higher time frame here? Well, very good question. The answer is still your bulls right now. Weekly higher lows are set at 129. So any move lower would be looking for a higher low. If Palantir is a rapid and sharp decline, I would be a big fan of maybe playing some options down here. If I can find some short puts under 120, you're not going to find them right now, right? But on sharp declines like we had, and don't say it's not possible, you just saw it a few weeks ago, right? That did open up some nice opportunities to sell some puts below there. So keep that in mind. I'm not adding to Palantir shares. I did my shot of adding. I built a position here and then DCA'd while all of YouTube called every single one of us clowns for investing in Palantir. I was accumulating holding shares, took profit. You guys saw on the channel, right? Over the past year, I've been taking profits in the 40s, some in the 60s, a couple more in the 80s. And my last batch of sales was in the 114 range, all of which were done with covered calls. And I might just be looking to wind down a few more shares of Palantir because the valuation, let's be honest, right? It's not cheap. They're pricing in a ton of growth. The next 5, 6, maybe even 7 years of growth to be specific. Moving on to SOFI right now. So SOFI down about 1.73%. I mean, nothing is happening with this company, guys. It's a financial at the end of the day, right? And the entire market looked something like, that's not the right one, looks something like this. You can't expect SOFI to be up every single day of the week, right? That being said, if we do consolidate a little bit more, just keep an eye, guys. If you want to know whether or not SOFI is ready to consolidate, just keep an eye on something that it hasn't done in a while. Loss of the 4-hour 12 EMA and loss of the 4-hour uptrend. This is looking a little bit like a daily 4-hour downtrend is starting. You get that, you're going to go into a daily down swing, not a downtrend because the bulls are in full control right now. The most recent higher lows are set 1744. Might just be looking for a bit of consolidation. I mean, what do you want, right? 83 on the RSI, phenomenal move on the weekly time frame. It's still looking very strong. That's why I say any pullbacks are just going to be for very healthy pullback looks. Possibly look for some consolidation before further trend expansion. And if they don't do it, if they just shoot straight up, guys, the next area of resistance is 24 down to 23. But I would be interested in playing some pullbacks. If we consolidate in a sharp fashion, I'll be looking to sell some options down here, 18 to 17. Moving on to Uber right now. Uber down 1.79%. Not too bad of a day, but of course, they've now unwound most of the most recent bullish leg of expansion. That being said, pay special attention to, well, this first area of support, which is 92 down about 91, and the higher lows here at about 90.15. If you flush these, it's a loss of the uptrend and loss of the support zone. It's not a very big zone, but it's the closest one we have. It opens up the door for a lower high into lower low, right? That's the probabilities now. When you give back such a big move like this and you almost give it all back, well, the probabilities are maybe for a bit of rollover, but that's not the biggest deal in the world, in my opinion. Why? The weekly time frames hold the key, guys. Nice weekly uptrend. The higher lows are down there at 82, looking for a bit of consolidation. If we do flush this zone, maybe you might be looking for a retest of the 12 EMA down there. We've held it on the weekly for a while right now at this point in time. So if we do consolidate fast and rapidly, I guess those are synonyms, into the mid 80s, you might just be looking for some short puts down there, lower 80s. I'll tell you guys if I do take that trade myself. And lastly, TSM. TSM was up 3.62% today. Very, very strong day for TSM. I'll remind you, they have earnings on Thursday. So any short-term price action is probably not going to matter because the stock will move 7% up or down. If we move 7% to the upside, you're going straight past 250. And if you move 7% to the downside, well, it might just provide a beautiful opportunity. Maybe buy some of these dips down here. 211 down to 200 is the next clear support range. If we move down after earnings, guys, you will see me most likely write some put options down there. And that being said, guys, the bulls would still be in absolute full control of this chart. Very, very nice price action by TSMC, just looking for a weekly higher low. So any volatility will be very welcome to this stock and the whole sector, and will allow me to maybe build some more swing trade longs down here, and maybe even look for some some short puts in this lower range down there. I'm still not selling any of my long-term TSMC shares at all. The valuation is still quite manageable, even at 236. You'd be looking at a mid-20s price to earnings and about a 1.5 on the peg. So not too bad, guys. Even though TSMC is at all-time highs, it still has some valuation expansion left in it, in my humble opinion, with these insane net margins. And of course, the demand, which the CEO has been saying for the past 2 quarters, is going to be extremely strong all year and all of next year too. That's everything I had for you guys for your major market rundown. Now we're going to do this quickly because the video is already over 1 hour and I want to kind of, keep it down. I know we're into earnings season and everything like that. So we'll start it off with the biggest gainers of the day. MP Materials, guys. I mean, MP Materials, there's a few of the people in my Discord that had insane buys on MP down at 20. And now a lot of those guys are up either 2 or 3x. And I was very clear on saying today, guys, on MP Materials, I understand that they have a monopoly on any US-based production within the confines of the US borders of critical minerals, but it takes time to build up that production, right? We already have guidance for everything that they will be doing over the next 4 years. And the revenue stream looks a bit like this. 970 million, let's call it $1 billion of revenue by 2028. You can only open and ramp up mineral production so fast, right? It's not as if you're producing soft drinks, right? Mining is very expensive. It's very slow. It takes a long time. So because of the Department of Defense contract in this company where they invested $400 million, sentiment around this one has just been off the charts, and it's very normal. The price action has been very, very strong, right? But fundamentals can't be thrown out the window. We are now pricing in 10 price to sales for the next 4 years, let alone price to sales for this year is terrible, right? You're talking about like 45 price to sales? That's like Palantir numbers, yeah? In 2028, after they've ramped a bit, and then again, they'll only be doing $1 billion worth of revenues from minerals, guys. That is not close to what the United States needs. So I understand it has a monopoly, but this sentiment and this pricing in and this expansion of the multiple, that is pricing in the monopoly as a matter of fact. So it's not a bad location, guys, to be selling some covered calls, right, on this stock higher than the market and maybe even taking some profits if you're up very rapidly. Just keep in mind, right, guys? They've priced in a lot so far. You guys are free to do what you want, but you've kind of blasted past your all-time high technicals here. You're overbought on the weekly. You're clearly now overbought on the daily as well. And you're overbought in terms of just pricing into the fundamentals. So take from that what you will. If you guys want to hold the entire bag, no problem at all. But maybe not a bad idea. If you have a lot of shares from down here, why not just make the trade free? Yeah, if you're up 3x, why not just sell your cost basis and then just ride the rest for free if you do have a long-term thesis for the next 4, 5, 10 years? Moving on to Baidu and Baba, obviously those were higher because of China's GDP. Second quarter growth beats forecasts, but deflation fears fuel calls for stimulus. So better than expected growth for the quarter. We're not going to go through the entire thing, but expanded by 5.2. The expectation was 5.1. I know what many of you are probably whispering right now. Yeah, but those are China numbers. Can we even believe what they say out of their country? I get it, but it's a headline and it did lead to the increase of stocks. I'm just here to tell you why things went up today. Industrial output also expanded by 6.8% from a year earlier. Slump in real estate investment still deepens, 11.2% of a fall in the first half of the year compared to a 10.7% drop in the first 5 months. So real estate still a pain point for the Chinese market overall. And you have the tariff wildcard. If the threat of trade war diminishes, at least in the short term, the chance of a large fiscal stimulus in China also declines. So they're balancing economic expansion with the need for stimulus. Essentially what they're saying is they don't really want to do stimulus if they don't have to. Now, Baidu specifically got some very nice news here, essentially. And the reason for that, it's not in this article, it is down below. Here you go. Uber accelerating global robotaxi push with another major deal. They are partnering, of course, with Baidu. Very nice. A nice deal with Baidu right there. Very good for ride-sharing services, but also for robo-taxi services within China, of which Baidu is starting to be a pretty significant player overall. That's the reason for the Baidu expansion. Alibaba also went up 8% off of the GDP news, which was pretty good. It showed that consumer sales were kind of bottoming out. We know that China retail sales have been slightly slow, but it isn't a bottoming out process, so Baba was also up. I mean, China, guys, you guys know my stance on this trade, right? I'm long K-Web because rather than picking individual companies, I'd rather go for the recovery of the entire Chinese economy, which I assume will be sometime over the next 2 years, which is why my leap call options are dated with 2027, expiry dates on them. So as of right now, clean, a little bit of expansion right now. But China's been a very difficult trade. Baba is not a bad proposition. A lot of people say, yeah, but it's so undervalued. I mean, Baba, guys, has been undervalued for 3 years. There's no change there, right? Baidu has been undervalued for the last 3 years. So it's not bad to build positions, but then again, you're counting on the expansion of the Chinese economy, which is going to be a slow thing to come back around, probably 2026 and maybe even to 2027. So keep that in mind for any positions that you do build there. I mean, SMCI has been up as well as part of the semiconductor trade. SMCI not looking bad. We were talking about this the last few days, looking quite good, right? So if you're going for the breakout trade, stop would go below here, 46.16, and your upside target would be this guy right there, 66. Not too bad, but then again, they do have earnings coming up the 12th of August. We also have other moves to the upside. Trade Desk being included in the S&P 500. Unfortunately, in the S&P 500, I know I talk fast sometimes, but the video is getting a bit long. Daily uptrend is nice, but they gave back a lot of the move because of the overall market weakness. I'm a fan of buying some Trade Desk shares here. They have their earnings coming up in early August. I like their most recent Q1 earnings. Nice S&P inclusion. So any pullbacks here, if we're looking to build some positions in Trade Desk, or even if they give back somehow the entire move, I'll sell some puts down here in the lower 70 range, maybe even build some swing trade longs to attack the resistance up here of $88 to $98 overall. CoreWeave, we're going to talk about CoreWeave very briefly right there. So CoreWeave coming into our resistance range right now, talking about 145 to 135. We've reset the lower time frames, going for the daily uptrend or the hourly uptrend shift right now, but we know it's a daily downtrend, yeah? So the expectation is we're going to look for a bounce, which is now underway. If the bounce can get 50% or higher, then the bulls have the best chance of turning this around. Right now, it's about a 50% bounce. So it's an okay chance, but for true expansion, you need the recapture of the daily uptrend. As of right now, I'll just be playing the volatility. If CoreWeave gives back most of this move and once again plunges over the next few days, I will be selling put options as close as possible to 110 as I can get. And the news for CoreWeave, of course, was the fact that they launched a, sorry, I closed the tab here. It's quarterly $6 billion. So they did a data center deal here for $6 billion. Pennsylvania data center deal, $6 billion. So pretty good, right? Expansion of the business overall, nothing else to say. I'll be playing the volatility on that one. And I know, I mean, there's a number of other names, but there's only so much time in these videos, right? To the downside, I mean, most of all the banks with which we've covered already, and interest rate sensitive plays, right? A lot of the home builders, Rocket Mortgage for me is a buy, 13 bucks all the way down to 12 bucks. It is a buy for me as I am going into a 2026 and 2027 expansion of the recovery of the consumer as interest rates come down, and the home builders trade as well. Could be an interesting one, right? We got some expansion, but if they come back here, I wouldn't be opposed to maybe building some leap call contracts from that lower end in the event that that interest rates stay a little bit higher for longer right now. And a 5-year trend line right there, 200 weekly EMA, horizontal support. So if I can get some lower 90s, for some bids, it's going to be a slow trade, right? It's going to require rates to come down. That's the type of stuff that I'm looking for overall. Other than that, the entire market was down. So maybe we can cover more of that tomorrow. That being said, that's everything I had for you guys today. Consider dropping a like, consider subscribing, comment if you want, and the link to the Discord is down below. All things trying to keep it under 110. That's it for me. Take care. Peace. See you tomorrow. Good luck.